2K. LOL. Yeah, let me pay for something that I can find free on the internet. Well, let's see what that free stuff on the internet has led this person to come across so far. It's not very good. There's a little spoiler. This is not a new topic in the sense of free information, the internet, is it possible to free, all that sort of stuff. Nothing new, but I had an exchange with somebody that is perfect because I realize I'll be the first to admit, kind of raise my hand. Yeah, a lot of videos where I talk about free information and how it can be dangerous and the internet, that is just theoretical. I haven't provided any actual proof in the sense of examples. I'm just, definitely making general statements. So I'll admit to that, but that's not the case here. A literal interaction that took place on YouTube. And if you find the right video, you can go and look this up, but I'll have a screenshot here of what a mentality of why would I pay for something when I can find it all for free on the internet has led to. And that comment that you saw at the introduction, that was actually the last comment in the discussion I had with this person, but I kind of wanted to start at the end. That way I can set the context for what's going on for the remainder of the conversation. And because at first I wasn't quite sure where this person stood, and then I got a little confused, and then at the end, everything, all the pieces came together. But remember, this is what the attitude of, why would I pay for something when I can just find it for free on the internet leads to. Let's get this conversation started. So Justin opens up this entire conversation by saying, I was looking to invest about $8,000 into ETFs. I want to grow my wealth for about 2 to 3 years while I'm in college. Once I graduate, my financial situation will change and I will develop a new strategy. I came across Robinhood. It looks easy to use and is free. Would this be a good idea for that strategy? I'm not looking to trade right now, but to simply grow my wealth in a convenient way. The first massive red flag in what this person has come up with is they've come up with, these are actually good questions that they want to ask somebody. Remember, I get it. I don't blame Justin. He's new. He doesn't know what he doesn't know. And when you ask certain questions, he is setting himself up for massive failure. Case in point, he wants to invest in ETFs. And at a core, hey, what do I think about a strategy of investing into ETFs? That's such a terrible question. If you know why that's a terrible question, good. That's a sign that you have a broader understanding of things. If you don't, I'm going to tell you right now, why is ETFs? Or why is this such a bad question? ETFs, there are all kinds of ETFs out there. The variety of ETFs is almost endless. Are there some super safe ones? Yeah, there are some super safe ones. Are there some really, really risky ones that wouldn't make any sense for what he apparently is wanting to do? Absolutely. In fact, maybe you're thinking of these right now. Those 3Xs out there, where they're leveraged 3 times. I'm not going to get into all that. But essentially, they decay over time. They are strictly trading vehicles. They're not meant for investing. Now, a lot of people think they're used for investing, and then they, well, what's going on? They decay over time, and I'll just leave it at that. But this person wants to invest. What happens if in this person's mind, they were looking at one of these leveraged ETFs? So they're defining ETF as one of these really stupid ones. And that's a good plan. So basically, I just told this person to go do something really stupid with their $8,000. That would not be good, right? Setting yourself up to be told wrong advice is not good. I realize I'm kind of hopefully stating the obvious there. Now, to be fair to this person, maybe they meant ETFs in like some bonds or some government securities, some grade A corporate bonds where, yeah, all right, whatever. It's pretty. Your 8K is going to be either give or take a little bit within 2 to 3 years. But they're just throwing out some general thing, ETFs. They want to invest in ETFs. Now, I eventually get down to the bottom of this, but keep in mind right now, very, very broad, a terrible question that they asked me that I could have answered. And then they also make the comment, 2 to 3 years. Now, first off, Justin, good job. You were being proactive with your money. I'll give you credit there. I don't have any, that's fine. That's fine, good. You're thinking. But 2 to 3 years to generate wealth, that's a very short amount of time. When people invest in the stock market and build wealth over time is not 2 to 3 years. Maybe if you add a 0 right here and a zero right there, 20 to 30 years, okay, yes, because markets do tend to go up over time. But to think that you're going to generate wealth and that 8K is going to still be worth 8K or maybe more after 2 to 3 years, could it? Yeah, absolutely. But within this whole plan here, it seems quite risky, and things are only going to get more risky as I press this person more questions. But right now, remember, this is their attitude. Why would I pay for something? I'm just going to go and learn stuff for free. Well, this is what free education has led them to so far, asking a really terrible question and then apparently not really understanding time horizons, because somehow they think that in 2 to 3 years is plenty of time for them to grow wealth and make that $8,000 expand. Let's see how much more risky this actually becomes. I reply back, it would work for that. Just make sure you are putting money in wise ETFs, as there is no guarantee the money will be worth more in 2 to 3 years. Justin replies back, I've researched a couple like IUSG, 120% growth in 5 years, contains companies like Apple, Amazon, Facebook, Google, etc., which I don't think are going anywhere. SPHD is another one with 106% growth in 5 years and has a high dividend yield of 4%. Those two seem pretty safe to me. There are all sorts of wrong things here. I'll touch on kind of the basic ones. But here is just a typical amateur, newbie, rookie, and I'm not saying that in a bad way. I started off there. But they make these basic surface deep jumps of logic, which makes sense. But again, because they don't understand time, because they don't understand really what's going on with ETFs, they're setting themselves up for failure. The one you probably caught it was, their logic they're using is, big tech companies, and those companies are not going anywhere. I agree. I highly doubt that those companies are going to be disappearing anywhere in the foreseeable future. But 2 to 3 years, remember, that's the time horizon that this guy's thinking with. Stocks fluctuate up and down. All these big tech companies could, without doubt, experience a big long-term pullback. Long-term might be 2 to 3 years, 4 years, 5 years. You may be thinking, that seems like a super long pullback. Yeah, but if you think that these companies are not going to go anywhere and going to be around within 50, 60, 70 years, then what's 5 years? It's nothing. Stocks can go on pullbacks and the company can still remain. You got to remember that. And this person seems to just be thinking that, that's not a threat at all. I just want to build that money. And so remember, good logic, there's nothing wrong with that logic, but when you add in the time component, that makes things not quite as black and white as this person, again, what free education has apparently led this person to believe. And then on top of that, these ETFs that have made huge gains, there can be massive gains out there. But who has heard the term high risk, high reward? Have those ETFs been high reward? Absolutely. However they're structured, is there definitely some high risk associated with them? Yeah, absolutely. There absolutely is, no doubt about it. If those gains, I didn't double check, so I'm just assuming those are real. But if they are real, those are not kind of your mom and pop type situations where, you're not guaranteed to make money, but the volatility is kept in check. But I mean, if something has the potential to make those sorts of moves, that is very high risk. And could it work out over the time span of 20 to 30 years? Sure, but that's not what he said. 2 to 3 years. And then the kind of cherry on top of all this is he put a couple words that don't make sense, that shouldn't belong to one another. A high dividend yield, so high percent dividend. And then in that same sentence said safe. Here's just a quick recap, or a quick kind of insight into dividend investing. High yields are not equated with safe, because the way the math works, the way dividends work, if those yields are getting higher, the higher they become, that essentially means the more and more trouble the company itself is actually having. Now, is that a black and white rule? No, but a general rule of thumb is, and if you don't believe me, that's fine. Go ask anybody that invests in dividends. Say, hey, would you classify and put high dividend yield and safe in the same sentence? And they'd say, no. Most times, I wouldn't exactly classify a safe stock as one with a high dividend yield. Are there unique situations out there? Sure. But the way this guy's described with these ETFs that have exploded, and then you factor in this ETF thing, and then you factor in the time frame, and then you factor in that right at the get-go of all this, he was just asking some broad question such as, invest in ETFs. This is what free education has led to. There's all sorts of problems with this. And if you are a veteran trader, if you understand what I'm getting at and you're still watching this video, please comment below. Just let other people, because I can be like, oh, whatever, you're just saying that because you sell courses and you're not mad that he's going to buy one of your courses. I'm not mad at all. But the proof is in the pudding here. Anybody with experience can see, yeah, there's things are not good. So let's finish out this conversation. I reply back to this person, you might want to tap the brakes. Your logic has all sorts of holes in it. Justin comes back, I'm still trying to learn more, but no one gives an exact answer as what you should do. Can you explain why these ETFs wouldn't be a good idea? Well, Justin, welcome to the world of freeloading. Nobody gives me an exact answer. Well, maybe because there's more to it than what you think. And you know what? I actually just gave you an answer. In fact, Justin, you got an entire video answering all those holes. Now, is this all still kind of surface deep? Yeah, but you got some pretty glaring issues here in terms of the time perspective, you know, high dividend yields not really being safe, those high risk with high reward. But, you know, I did chuckle when I meant, nobody will give me a straight up answer. Well, like I said, free isn't necessarily free. Free comes with headaches. Free comes with bad information. Free comes with, is this even good information? Free comes with lack of structure. That's just the way it is. So I can't say that I'm shocked to hear that nobody has given you a straight up answer on why this whole situation may not be a good or bad one. I reply back, quote unquote, what you should do is a loaded question. I mean, I offer training courses here, then I link them to the training courses, but from the way you are talking, you don't really have the time, desire to do any in-depth learning. Justin replies back, I do, it's just very confusing to decide where to start on investing in the market. And I reply back, and that's exactly what my courses are geared around. Not in my budget right now. I reply back, I'm confused, or maybe it was a typo. You said you had $8,000. Did you even look at my prices? My biggest package that contains everything I have to offer is only $2,000. And then we get to where we opened, only $2,000, LOL. Yeah, let me just pay for something that I can find on the internet. Keep in mind, their words, not mine. I'm assuming you have reading comprehension skills. They are out there like a chicken running around with their head cut off. They don't know what to do. What should I do? They're asking some stranger on YouTube. They're asking terrible questions. And then they're literally saying, I don't even know where to start when it comes to all this stock market stuff. Their words, not mine. And then I offer them structured education. No, it's not my budget. What do you mean it's not in your budget? Well, and then, you know, the ultimate attitude. Well, technically it is in my budget, but why would I do that? And I didn't capture this entire conversation, but really this person's final kind of comment was, I've always figured out on my own, I'm gonna do that here. I said, hey, that's cool. Just make sure you have a big bankroll because you're gonna burn through a whole lot of cash, probably including that $8,000 with the path that he seems to be on right now in terms of what he's learned from the free education. So free education, is it really free? Yeah, it is free, but this is a real life example of what free has led to up until this point. And it's a mess. And this person even, I mean, now that I'm thinking about it right now, it really doesn't make any sense at all because this person admits about halfway through the conversation, as you saw, they don't know where to start. There's just, what should I do? They're very confused. Yet they started off the conversation with some sort of strategy. It makes so much more sense, but it's yet so ironic that they have this strategy that really doesn't make any sense. But how can you put together a strategy when later on you're admitting that I don't even know where to start with all the stock market stuff? Well, then how did you even put together a strategy in the first place? Can you see the mess that free education brings about? Is it really any shock on why the statistics are 90% of traders fail? I say this all the time, but it's so true. And this is a great example of how that's the case. But if it really was just as easy as I'm going to read the internet, I'm going to watch YouTube, I'm going to go on blogs, I'm going to go to the library, use all this free information, then why is the success rate only 10%? You would think that it would be higher, at least maybe 20%, 25%, heck, maybe even 30, 40%, because I mean, all this stuff is free, but free education, chicken with their head cut off, and this is a honest, real life example. I promise I did not make this up. But yeah, so maybe you want to reconsider the whole free education route, whether or not you choose my courses to invest in, or maybe your eye is on somebody else's and you decide, you know what, Clay, I'm going to go with theirs. Hey, good job. Hey, that's fine. At least you're taking that step. At least you're going to get some sort of structured education. Of course, I would love for you to buy mine, but even if you don't, just realize that free isn't necessarily free. If you are out there trading alone currently and maybe are in the market looking for a community to join to assist you in your trading or to just help you, give you another set of eyeballs, then I do have a private trading community where you can trade alongside me and other experienced traders. So what you see popping up on the screen right now is both an information link. So if you click on the inner circle one, that is going to take you to the page where I explain all the details of what exactly come with the community, both the chat room and the newsletter. And then the other image that has popped up is a behind the scenes tour where you can see exactly what is going to be contained within the community. I take you through, like I said, a behind the scenes tour of everything, and that way you'll know precisely what you are getting when you join. So definitely check that stuff out if you are interested and thinking about wanting to join a community, and let me know if you have any questions.